Hey, hello, Jack Tubbs from the J Team at Realty One in Surprise, Arizona, wishing you a fantastic Monday. Enjoy some of this beautiful sunshine and a little bit cooler weather. Hey, my check-in today, or I'm sharing with you today, talking about mortgages again today because something new just got reported on the Housing Wire that I thought would interest some of you. We all know that right now on a conventional loan, the debt to income ratio is 43%. So in other words, you cannot have any more debts that take more than 43% of your current income to qualify for a conventional mortgage. Now, there's been a patch that has been allowed by the CFPB, which is the Consumer Financial Protection Bureau, basically because Freddie Mae and Fannie Mac loans ask for a lower down payment. Usually they have some other things built in that, like the PMI, the private mortgage insurance, to make sure that the lender that is issuing the loan is going to have that insurance there to back them so that they have some coverage in case a borrower should default. In other words, they don't make their payments and the property goes into foreclosure, that the issuing bank, the lender, will get at least 20% of the value of the loan to make sure that they're covered in case the housing market should fall, and then they make sure that there's, when they go to sell the house, that they should be able to recoup all of their losses in the event of a foreclosure. Now, the 43% debt to income ratio has been what a lot of people thought was kind of stringent, and this was to make sure that nobody got in a loan that they couldn't afford, that they say that they already had expenditures that took up, say, over 50% of their income, and then they added on a mortgage on top of that. Well, they instituted the 43% debt to income ratio to make sure that nobody got in a hole, that got into a mortgage that they couldn't afford. Well, but that's also held some people who have the income to not only pay that more than 43%, but also to make the mortgage. It's kept them from being able to qualify for a mortgage. And also some of those who have slightly bruised credit, it's also made it harder for. So now the CFPB, the Consumers Financial Protection Bureau, has decided that they're working on what they call a patch, which they're going to look at the rate of the loan, what the prime rate is, to see what the disparity of that is. Also, they want to make sure that there are no more than two 30-day late reports on a credit report, and 60-day late reports on a credit report. And also they do this on what they call a seasoned loan. In other words, somebody who has borrowed before, they're going to refinance, etc. And this is really probably going to be the best product for somebody who is an FHA loan that's backed by Freddie Mac or Fannie Mae, and they have the PMI, and now they have 20% equity in the property. They want to refinance so they can drop off that private mortgage insurance, which is can be quite a bit. It can be as much as $300-400 a month, to lose that off their loans so that their payment drops. So this would be a great thing for them, but also for those of you who have had mortgages before and you've had a good record, you've had no 60-day lates, you had maybe a couple of 30-day lates, and they haven't defined the time length on that. I think it's probably going to be 12 to 24 months, somewhere in there, that as long as you have no more than two 30-day lates and 0 60-day lates in that amount of time, you're going to qualify for this. And then they're going to change what the debt to income ratio is. They're probably going to expand it. It may go as high as 50 or over 50%. Also, it's going to depend upon, yes, your income, and yes, your ability to pay, which we talked about a couple days ago, the APT. So this is really some exciting news for those of you who might have debt that takes up a little bit more than 43% of your income right now. It'll still let you qualify for a conventional mortgage. Also, it'll be a patch that will be able to apply to all sorts of different things, probably even some non-conformings where you might have a balloon payment or something to that effect. But this is exciting news, and I think it's something that you should know about as you're moving forward in the buying process. Also, for those of you who have been in a home for a while and you have Fannie Mae or Freddie Mac loan and you're paying PMI, know that you can refinance as long as you don't have any more than two 30-day lates and 0 60-day lates. And I'm going to say probably in a 24-month period that you'll be able to refinance, drop that PMI, and even if your debt to income ratio is over 43%. This is really cool. So anyways, this is some news I thought I'd share with you. If you have any more questions, or if you need a referral to a lender that can help you out, maybe even for a refi, but especially for a purchase, please give me a call. You can get a hold of me directly at 248-330 7972. That's 248-330-7972. You can email me, Jack at thejteam.house. That's JACK at THE, the letter J, TEAM.house. You can call the office and talk to anybody on my team, 623-252-4061. Hey, this is Jack Tubbs from the J Team at Realty One Surprise, Arizona, wishing you a fantastic day. Enjoy this beautiful sunshine, and I will be back tomorrow to talk a little bit more about the Phoenix real estate market. Bye-bye.